Many people will conclude the greater risk is deflation, but deflation can be a very good thing if it is caused by technology and progress. We think growth is going to be scarce this year, and as you know, innovation is all about growth. The stock market has not seen a worse year to date since 1962. What's happened in the crypto market gives you a sense of why it's going to work long run. The bad news is that the Fed has become extremely aggressive and hawkish. The good news is that we are beginning to get data that is confirming that the economy, the U.S. economy, is in recession. And if you've tuned in before, you know that we believe that Europe and China effectively have been in recession as well. So now a global recession. We're also getting a lot of indicators that prices are coming down. And I think this notion that the inflation that everyone has been worried about is quite a wrong way of looking at the world right now. We believe that deflation is the much bigger risk. We've been saying this for a time. We've been ridiculed for saying it. And we were challenged by those who were sure that we were back into a 70s style inflation scenario. Many people will conclude the greater risk is deflation. And as you know, we don't think deflation is a bad thing per se. It is a bad thing the way the Fed has approached it, we believe. But deflation can be a very good thing if it is caused by technology and progress. And we think we're going to see a lot of that over the years. But right now, we're looking at bad deflation. And we're going to have to get through this. I think the next Fed move is supposed to be at the end of this month. And the Fed is out of its quiet period, so all the Fed governors have been traipsing out, saying we're going 75 basis points, another 75 basis points. Well, we think that they will rethink that in this month as we get not only more pricing signals, but earnings reports and guidance from companies who will be probably confirming that the U.S. is now in recession. We think growth is going to be scarce this year. And as you know, innovation is all about growth. Innovation is also about solving problems. We have a lot of problems now. A recession is going to be providing another set of problems. So lots of work for innovation to do, and that's where we believe you will find real growth. There's already a lot of deflation in the economy. And and one of the reasons the deflation is accelerating here is because the Fed has shocked the system. We have gone from 0.25% in the Fed funds rate to 1.75% in the span of 3 months. That's a 7-fold increase. We've never seen that before. Now, I know a lot of critics are suggesting, oh, what are you talking about? From such a low level. You can't make a comparison to the early 80s when interest rates went from 10, Fed funds rate went from 10 to 20%, which was only a 2-fold increase. You just can't make that comparison. Well, yes, I can. I can make that comparison up 5-fold very quickly. I think the Fed has panicked, and it's causing the economy a lot of problems. What are the deflationary signals we're seeing out there? Well, one of the most obvious, but one that very few people mention, or maybe they don't monitor, are credit default swaps, CDSs. Now, this is the price of insurance against bankruptcy. And so when the price of this insurance goes up dramatically in a short period of time, I certainly take note. So the 5-year CDX, as measured by Markit, M-A-R-K-I-T, has gone from 50 to 100 year to date. And for JP Morgan, so a money center bank, It has gone from 48 to 102. So JP Morgan's credit default swaps have gone up more than the market's average. That's very interesting, and we're trying to figure out what is that all about. We know that JP Morgan is a fortress. It's not going bankrupt, but there are some investors concerned, or concerned that there might be something systemic going on. This doubling in credit default swaps for the market's average and JP Morgan has us asking questions. Is there something systemic out there? Our guess is that if there is, it has to do with the reach for yield that we saw during the last few years as interest rates went effectively to zero on the short end and as low as 0.5% for the 10-year Treasury bond yield during the coronavirus. Now, reaching for yield, if on top there's leverage, could be a problem. From my experience, the velocity of money is influenced by a few variables, one of which is sentiment. If people are scared, as they were out of 08-09, and they're more scared now, if people are scared, they spend less. Now, we haven't seen that yet until May. May, we had a negative consumption number outright. It was minus 0.4. We'll get into this in a minute when I talk about economic indicators. What that tells us is, yes, the consumer is now pulling back and not betting that prices and interest rates are going up and I have to beat them and buy whatever I want now, whether it's a home or a durable good. That behavior, if it existed, is stopping, and the velocity of money, which is the rate at which money turns over, as the consumer chases in an inflationary environment, it turns over faster. As the consumer recoils, it turns over slower. If the velocity of money is slowing, that means that GDP growth will be less than money growth. And if money growth turns negative, as some people think it will on a year-over-year basis, it already has year to date. It's down from its peak. But if it were to turn negative on a year-over-year basis, then the GDP growth falling further below that would be quite the recession. So we're very focused on confidence and this notion that deflation is actually going to cause the opposite. If you expect prices and interest rates to go down, then you'll hold off buying. And if you're scared, you won't buy anything to begin with. Another curious thing that we learned from the data that came out, reported in this last month, was the GDP revision for the first quarter. Now, the GDP number comes out first month after the end of the quarter. It's revised in the second month and revised again in the third month. So in June, we got a second revision for the first quarter. The most surprising thing in that revision, first of all, rarely is much revised in the third revision, but this time, real consumption, which was originally reported at 3.1% in the first quarter, was revised down to 1.8%. Now, that may not sound like a big adjustment, but that's nearly cutting the growth in half. I've never seen an adjustment that big. And I think what's happened, and this has caught a lot of companies off guard, is the consumer just started shutting down. And we saw in April, the original number reported was 0.7%. That was revised down to 0.3, which when you adjust for inflation was probably down 0.6%, something like that. In May, the real number was negative, minus 0.4. So we are seeing declining consumption. And we know from Target and Walmart, who have been shocked. I can tell from the way managements answer questions. They're shocked at how the consumer has turned off, and they are shocked at how their inventories have ballooned. We went through this last time, so 33%, I think it was for Walmart, 42% for Target. I think even Costco, 26%. Home Depot, I think, was 32%. I mean, these are massive increases, and it's going to take a while for them to unwind. So what are they going to do if they want to clear their shelves? They are going to cut prices, and they have said they're going to cut prices. So there you go. Deflation. Every day economic statistics come out. The Atlanta Fed adjusts its real GDP number for that quarter. And today they reduced it to a decline of 2.1%. So 2 weeks ago, 2 or 3 weeks ago, they had a positive 1%. Last week they went to a minus 1.1%, and now it's minus 2.1%. So put that together with real GDP at minus 1.6% in the first quarter, and we have a recession. The technical definition of a recession is 2 consecutive negative quarters of real GDP growth. So we have them. So now let's go to markets. Well, crypto had its worst quarter since 2011. And it's a much more mature market than it was back then with the boom bust. So that's saying something. The S&P down 20% year to date, NASDAQ down roughly 30%. So the stock market has not seen a worse year to date since 1962. And that was when the Cuban Missile Crisis took place. And then what happened after that is we ended up in the Great Society, guns and butter, and inflation took off. But first, the stock market was a barn burner. It was very hot from 62 to 66. When it comes to bonds, this has been the worst year-to-date performance in bonds in anyone's lifetime. I want to spend a little time on crypto. It has been an incredible month, and fears of systemic collapse have been rife in the marketplace. So we've seen Bitcoin, it peaked way back in November at 69,000, and it is now at 19,500. It is still higher than its pre-COVID 7,000 to 10,000 range, and it is just about at its 2017 high. So this could be some support. It's also at it is below its 200-week moving average, which is at 22,500. So there is some concern that is the new resistance. The transparency in the market, I think, is the reason we've seen a lot of failures very quickly. We have, compared to the opacity in the traditional financial markets, I think the shakeout in crypto has happened sooner and faster than it would have in the traditional financial markets. It's interesting that BlockFi is going to FTX. We know that 2 other platforms or companies, Lendn, which is Ledn, which is a lending platform in Canada, highly regarded, also seemed to be interested, as did, I believe, Morgan Creek. Now, these are people who really know what's going on in DeFi, and if they're willing to step in here, that has increased my confidence to some extent that the systemic risk is diminishing here. What's happened in the crypto market gives you a sense of why it's going to work long run. It's transparent. And there's a lot more trust in the crypto ecosystem because of the transparency and the over-collateralization than I think there is in the traditional financial markets. And when we wonder why are the CDSs going up on these banks, we wonder about the reach for yield and how leveraged some of these situations are. And we don't know where they're hiding. And so maybe that's all this is like, okay, the crypto market has alerted us that this reach for yield it went way too far. There are too many excesses, too much leverage around it. Hedge funds leveraging 10 to 1 when yields are 2% so that they can reach the returns or their return objectives. Maybe there are some problems out there, and we will find out. But for right now, I'm really, number one, that we have so many signals that will get to the Fed in some way, shape, or form, even if they have to wait for the CPI. I even think that will be a bit too much given what's going on out there and given the recession we're in. But at least the numbers, and part of this is downward revisions. Originally, the Fed thought these numbers were very strong, consumption very strong. No, consumption's falling apart. So believe it or not, bad news is good news now, as tends to be the case in a bear market when inflation is a concern. So bad news is good news, and it's always darkest before the dawn. And I believe we've passed the darkest place.